Hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Today we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. Hello everyone, Chad Frantzen. Thanks so much for joining us here on the Kingdom Finance Show. I'm really glad you're here. Hey, if you haven't already, please leave us a review and subscribe to the show. Pass it along to friends and family that you think would value from learning more about making sense of making money for making a difference here on the Kingdom Finance Show. Again, our goal is to empower you to use a Christian worldview as business owners, families, entrepreneurs, investors to make sense or make clarity out of chaos in the global economic environment. So again, thanks for being along. This week, we are going to talk about the echo bubble. We're recording this here right at the midpoint of 2023, and I want to share some interesting statistics on what's happening in the markets and also our thoughts on things as we move through the summer and into the fall. Of course, these are just my personal opinion, not giving investment advice here. If you want to learn more about personal investing and how you can create a financial plan that does not violate your personal values for yourself and your family and your Christian faith, visit us online at wealthbuilders.net. That's wealthbuilders.net. And oftentimes we have some free downloads, free content to send to you. You can check that out at wealthbuilders.net/invest. That's /invest, INVEST. All right, well, let's get started. Again, we're looking at the markets here at the midpoint, 2023. We've talked a lot about the Federal Reserve and Chairman Powell and the meetings. And if you followed us on any of our client webinars that we do or what we share here on the show at Kingdom Finance, then you know this is something we follow very closely. The Federal Reserve is really a group of central bankers that form monetary policy in the U.S., and there's a board of governors over the major cities in the U.S., and then they meet periodically, usually 8 to 10 times a year. And what we had been anticipating, we had a big Federal Reserve meeting on June 14th. Now, we've been having interest rate after interest rate increase since last year. We've had an all-time record of rate increases. So remember, 2/3 of the economy is what you and I spend as consumers. So whether you're a retiree, a student, stay-at-home mom, engineer, or a professional of some type, what we spend in the economy is that's what drives it. So 2/3 is really consumer spending. And interest rates, just as a refresher, interest rates dictate the flow of money. So this is why it's important to understand what's going on with monetary policy, Federal Reserve, and even what other central banks are doing across the world. So think of the supply of money. It's kind of like if you're playing Monopoly. If you've got more money on the table in your hand, or if the banker has it all and is not giving it out, then that's going to dictate how many things you can buy on that Monopoly game board. So same concept here. When interest rates are low, it's more of a free money environment. And we certainly came out of that. And this is all cyclical, so it's nothing to be afraid of. It's just a part of the economic cycle. Certainly the central bankers, they over-tighten or under-tighten from time to time. So it's not a purely efficient system. So what we want to know is coming out of COVID, even pre-COVID, we had very, very low interest rates. So free money. The velocity or the flow of money was everywhere. And some people would even refer to it as helicopter money. There was just money everywhere. If you wanted to do something as a business or buy real estate, I mean, you could get loans for 3%, sometimes less, on that. Now, we're now in a much higher interest rate environment, right? So if you're looking at getting a mortgage, mortgages are 6.5% to 7%. So they're more than double worth what they were a year ago. So again, the flow of money has slowed down. So the federal bankers refer that as being hawkish. So when you're raising rates and you're being tight with the purse strings, you're being hawkish. When you're loosening the purse strings and you're making money more freely available at much more favorable terms, it's considered being dovish. So there's your animal analogy for the day. You can be dovish or hawkish. So if you ever see that in a story headline, if you're reading economics, that's what that means. So the Federal Reserve has been very hawkish, raising rates at every meeting. And we've shared this on some of our client webinars and also here on the show that June, July, we really thought June, July, and September are the next three meeting dates for the Fed. And we really felt like in that spot that was the sweet spot for some changes to start to happen. So June 14th, here a few weeks ago, the Federal Reserve paused and they did not raise the federal interest rate. Now, that was widely anticipated leading up to it, just with what the bond market was suggesting. However, they did come out and say that we're not going to raise interest rates, but they did suggest that 2 more rate hikes were very likely. And that did surprise the markets. Now, this is the first pause since early part of 2022. The Fed's statement and their projections indicates a very hawkish pause. So we're going to pause on rates as of June 14th, but we're not pivoting down to lower rates. And in fact, economic numbers, GDP for first quarter came out positive. Inflation is still there, still stubbornly high, and it's been some of those inflation numbers are higher than what they want. Unemployment rate forecasts were revised lower, and that's recognizing that the Fed's tightening of interest rates has failed to lift the unemployment rate above the target, which was 4.5%. So really the Fed would like to see unemployment closer to 4.5%, and they would like to see inflation at 2%. So they're not there, but they recognize there's some cracks in the armor, particularly when we look at banks and we look at what's happening with real estate, and they're recognizing they need to tread lightly on that. So again, the takeaway from that is the Federal Reserve did not raise rates for the first time in over a year, but they did imply in their public comments that they forecast 2 more rate increases. Now, historically, I don't think that's ever happened where the Federal Reserve has gone on a rate hike splurge for several months and months and then stopped raising rates and then raised them again. That doesn't happen that often, if at all. So we'll see what remains to happen there. So July 26th is the next Federal Reserve meeting. Again, we're filming this in between the 2 Fed meetings, and then September 20th. So for those of you keeping score at home, I do think July 26th and September 20th, those are going to be important dates to watch what the Federal Reserve says, not only what they do with rate policy, but what they say, because that's the key thing. The takeaway, as I've already iterated in June, was that rates we're not going to raise them, but we forecast 2 more rate increases. So what will happen in July 26th? What will happen in September? Historically, bear market crashes, for whatever reason, they tend to often happen in September and October. You can go back and look at the historical charts of the markets and things. So that's a very, very curious for me to watch that. So again, we're sharing all this because we want to understand how to get clarity out of chaos with what's going on in economics and in the business world on that. So let's pivot a little bit. I want to talk about the markets, and then I'll finish up here with some thoughts on what's happening with real estate and with expectations for the fall. So again, I've titled this episode "The Echo Bubble," and what I mean by that is there's a group in our investment industry that use this term, in that we have been in a bit of an everything bubble with asset classes. So leading up to 2022, crypto, stock, real estate were at all-time highs. And then, of course, we saw gold reach a near all-time high here early in 2023. Of course, last year in 22, we saw the stock market. We saw the stock market and crypto have a pretty hard crash. But interestingly enough, the bear market did not hold, and stocks and crypto, I'm going to speak specifically on the stock market. I think a lot of you are probably more invested there because of IRAs and 401ks and college savings accounts. So since that market correction last year, the stock market has slowly and steadily creeped back up. And that's what I refer to as a bear market rally. Doesn't mean that it's all clear, that there's no big waves or tides coming in. It's not an all clear to get back in the pool and go crazy. What it means to me is that it's pretty typical of a bear market rally, and where the bubble is starting to get larger and larger. So it's an echo. If you think of an echo and what that is, right? When you're standing in a canyon or in the mountains and you shout, and your voice, right, that sound wave reverberates across, comes back to you, it echoes. I think the same thing applies here, is that these assets are now creeping back up and doing the same thing they were doing before the most recent correction. Now, behavioral finance would tell us the continuum between greed and fear is the most powerful challenge we have. And I would even say that the hardest thing to do is not choosing what to invest in, it's when and how, when to buy, when to sell, when to hold. It's really the behavior of, I don't want to miss out, and I don't want to lose all my money, and everything in between on that. So give you a couple of statistics here. The NASDAQ, which is the technology index, for the first half of 2023 is up some 35%. That's the best half a year, 6-month start to a year for the NASDAQ since 1983. So again, up over 34, 35% in 6 months. We've seen a huge run up in the technology stocks on that. Again, a lot of that is anticipating that the Fed is going to be very favorable with interest rate policy, and that we have more of an all clear. A lot of that's been driven, as I've shared in the past, about AI, artificial intelligence, and what's going on there. Again, just more of asset bubbles. These are values that are not based on earnings. They're not based on intrinsic value. They're based on speculation. So if you're a Warren Buffett value type investor, these are not the types of companies you're most likely going to be investing in. The S&P 500, which is the index of the 500 largest publicly traded U.S. companies, it has posted its best first half of the year since 2019. And it's the third quarter in a row that the S&P 500 has posted a positive gain. So to me, it feels a lot like the late 1990s, early 2000, all with the backdrop of a potential pending regional banking crisis, a la the savings and loan crisis of the 80s. So again, history doesn't repeat itself, but it does rhyme sometimes. So I think what we're seeing here is this echo bubble. These asset classes are going back up. They're really thinking that, hey, the economy is going to be fine. We're not going to have any sustainable repercussions from these really high interest rates, really stubborn inflation, and hey, everything's good. So I am not personally of that opinion. I think we need to be really cautious when we look at these echo bubbles and where they are valuation-wise. Now, one of the things I'm concerned about is if we get into July, September, and we start to see more negative economic data, or let's say we see more favorable economic data. If the economy continues to stay hot and job market continues to stay hot, the Fed will have no choice but to continue to raise interest rates the 1 to 2 more times that they've already forecasted. Now, the higher rates go, again, back to how I began this episode, is that less supply of money. Now, if I were to ask a show of hands, how many of you would be in the real estate market to buy either a personal home, a vacation home, or an investment property, retail or commercial, if mortgage rates were above 8%? I'm doubting many of us would. Some of us would be cash buyers. Some of us would be moving out of things and maybe doing an exchange into something, and that wouldn't be as relevant. But if rates keep going up and inflation stays stubborn, then purchasing power is going to continue to drop. Discretionary spending, vacations, Harley-Davidsons, extra vehicles, real estate, things of that nature. Discretionary spending is going to continue to go down. We've seen Costco and others report that their sales are down. But again, the stock market is not too worried about that. Now, what would be really crazy is if we get into the fall and the Fed has been saying all these things about, hey, we got to keep rates high. We've got to fight inflation. And what if? Here's the outlier. And I don't have a probability on it, but I've been doing some thinking on it, is what if the Fed cut rates? What if we get into August and September? I'm thinking especially September 20th Fed meeting, and they've been forecasting, hey, more rate hikes. Everything's hot. We got to keep it down. If we see some major economic data or geopolitical events and the Fed out of nowhere cuts interest rates. Now, intuitively, we would think, hey, Chad, that's actually really positive, right? Because their money's going to start to become more affordable. Well, yes, but the markets are not anticipating that. And so I do think if we get into the fall and we see some major geopolitical, major economic strain, and the Fed says, hey, we were talking about raising rates a couple more times, but we're actually going to cut rates 1/4 of a point. I believe that would spook the markets, and I believe it could lead to pretty widespread panic and a major market correction. Now, I think long-term things settle themselves out, but remember, historically speaking, the Federal Reserve tends to overdo it. They tend to miss their mark. They either raise rates too high for too long, or they keep rates too low for too long. So as Kingdom investors, we just need to be mindful. We need to understand the signs of the times and what's going on with policy. Because the takeaway from this, and the reason I'm spending a good amount of time on this today, is that determines what types of assets we should be stewarding, to what measure, and to what length. Whether you're a business owner, a franchise owner, whether you're investing in stocks, bonds, real estate, metals, any number of things, right? I mean, there's all sorts of things that you can invest in living in America, living in a capitalist society on that. The key thing is to know to what measure, to what degree. I should add more to this because based on what's happening, these type of asset classes are going to do better than others. So those are my thoughts. I know several of you have reached out to me, and I wanted to share some of that here on a mid-year update, talking about this echo bubble and what's going on with the Federal Reserve. Again, each of you need to have a cohesive financial plan, have a financial strategy for your family, for your business, that you can monitor, that you can implement, but also that can take advantage of these uncertain times that we are in. I'm going to speak a little bit on mortgage rates, real estate market. Now, we talked about how the Fed did not raise rates in June, and mortgage rates fairly unchanged I mean, the 30-year mortgage is still sitting around 6.5 to 6.75. Again, that's variable. So depending on where you are in the week, it does go a little up and down. But the main observation I have from talking to real estate professionals and my own observations is many people are trapped in their current home because interest rates have more than doubled in a year. So many homeowners, and there were some statistics we shared in one of our client webinars, many, high percentage of folks have a primary residence with a mortgage that is under 4%. Well, the thought of, hey, yeah, we'd really like to move across town, or we really like something a little bigger, or maybe we're going to move closer to school or work, or any number of just everyday things of why people would move. People are reconsidering that because they're like, well, we do have this house at 3.5% or 4% mortgage, and if we sell it, we'll make a good profit, but we're going to have to buy a house that's more expensive at a double interest rate from what our mortgage is now. So I think a lot of folks are trapped, and even if you look at the seasonality, spring and into summer, historically, you always see a good volume, or what we call home inventory. But in home inventories in a lot of the states that I follow, Colorado, Texas, and some others, still not historically where they should be, right? And so what has happened is with mortgage rates where they are, now, to be fair, we're seeing some slippage in home prices, and I know many investors who are finding some good deals here and there. So, you're able to find some opportunities to buy property for less than what the seller's asking. Some homes are staying on a little longer, right? 45, 60 days. But in general, my thesis, my opinion is these higher mortgage rates are preventing more inventory from coming on for the reasons I've already stated. And it is because of the limited inventory, it's putting a floor under the value of homes. So there's pluses and minuses to that. The main thing is we had, many of us expected more of a drop in real estate prices as rates went up. What we've seen, though, is there's been some, and certainly in the ultra hot markets in the run up, the Vegas and the Phoenix and Miami's and New York, of course, those that went up the most are coming down more. But in middle America, in your major blue chip metropolitan cities and outlying cities where you've got good jobs and good schools, you're not seeing huge downturns in real estate prices because the limited inventory has put a bit of a floor under that. Because at some point, if you're going to buy, you've just got limited fish in the pond to fish from, to catch, right? So again, we'll see how that goes. I do think, as I've shared before, I think the equilibrium rate for mortgages, I think, is really around 5.5%. I think that's what we expect to see them level out to. That may very well be into 2024. Again, just personal opinion there. But I think long-term equilibrium for mortgage rates, again, talking about a 30-year mortgage, 5 to 5.5%. I think that would get us closer to where we need to be and a healthier supply-demand on housing. So anyway, I hope this has been helpful. Again, a mid-year look at the markets and the economy, the echo bubble. Be aware of what's going on. Summer, things tend to slow down right in the markets. I do expect as we move into the end of summer and into fall, we're going to see a lot more volatility in the markets and in the economic news cycle that we need to be aware of. So yeah, bottom line, I think any Fed rate hikes in July, September, or a random rate cut could really exacerbate market volatility. But again, these asset prices where they are now, particularly I'm referencing the stock market, almost back to all-time highs. Not quite there, but pretty incredible that where we're there with inflation still high, with interest rates still high, and we're being told they're going to go higher, but yet assets continue to melt up in their prices. Well, hey, I hope this has been enlightening, just to give you a mid-year insight on the markets, kind of what we're thinking. Again, as a kingdom-minded investor, what we want to do is make sense of the economic news and the data, and we also want to make sure that we are not commingling our Christian, Christ-following values into companies, into assets that are absolutely against Christianity, that violate the ethics of the Bible. And we want to invest in things that support biblical family, First and Second Amendment. And we want to invest in companies that do not censor free speech, right? And so I think just to wrap up here on this week's show, this is all really helpful. We're kind of getting in the weeds. We're talking economics. We're talking financial markets. Again, our team at Wealth Builders Investments is here to help you. If you say, hey, I'd really like to understand a little bit more of how do I apply what you're talking about, Chad. Some of you may say, hey, I don't understand half of what you're saying. So you probably already stopped the podcast. So I'm sorry. But some of you may say, okay, I get some of this, but what do I do practically with my personal finances, with my business finances? How do I navigate this? That's what our team at Wealth Builders Investments is here for. So we've got a team of advisors here to help you. So please reach out to us. You can email us directly, info@wealthbuilders.net. And we'd love to visit with you one-on-one, and of course, connect with us on social media, Facebook, and on the podcast show, and wealthbuilders.net for that. But again, in closing, I think and I'm going to talk more about this, I think, on next week's podcast, is we've got to make up our mind that there will always be chaos in the world, but that we have the mind of Christ, and we can surround ourselves with counselors, with wise counselors that can help us make decisions to where we're stewarding what God has put before us with excellence. And the first step in that is to not commingle our businesses, our investments, what we are supporting with companies that are vastly on the socialism, left liberal leaning agenda that is in complete violation of the teachings of Christ and of your ethics. If you're a true kingdom-minded person who, when you read the Bible, you say, you know what, that's still true. It's not relative. And so I want to encourage you in that. Check out our other episodes. We talk more about that and how we do biblically responsible, pro-values, and what I like to call kingdom impact investing. That's what we're real passionate about. So, hey, thanks for joining us today on the Kingdom Finance Show. Again, please subscribe, pass this along to a friend, and we look forward to connecting with you all soon. Take care. Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.